Hello everyone and welcome to downtown Wayne, New Jersey on Route 23. It is Keller Williams Prosperity and we are Messercola Real Estate Group. Tonight I'm excited to have our esteemed colleagues with us for our Sellers Seminar. For the next 30 minutes or so we'll take you through the intricacies of prepping your home to sell and all of the nuances associated with getting you through a successful sales transaction. So I am going to go around the room and ask our colleagues to introduce themselves, tell a little bit about what their background and experience is, and we'll get rolling from there. I am going to start with the handsome young gentleman on my right.
Awesome. Hello everyone, my name is Nico Andrusakes. I'm a mortgage loan officer at Luminate Bank. Our team's been in the business for well over 30 years. We specialize in residential lending. We help individuals buy and sell homes, which we'll get more into it.
Excellent. Michael?
Mike Flower, Financial Principals. We're in Fairfield, New Jersey. We're a financial planning firm. Been in existence for about 30 years at this point, and we work with individuals and small business owners on ways to save and invest, different insurances, but ultimately become financially independent.
Excellent. Thank you. Matthew?
Matt Kopeleckia. I'm a real estate attorney. I have about 20 years of experience. I represent buyers and sellers in real estate transactions, residential and commercial.
Thank you. Jason?
Jason Caleri, managing partner of Claire Carico, specialize in small businesses, high net worth individuals. Focus of the firm is tax audit and advisory services.
Excellent. Thank you. And Jason is a newbie here. He's a first timer, so we welcome Jason.
Welcome.
We'll be delicate on him tonight and won't poke and prod too much. And to our team lead.
Hey guys, Francesca Messercola Real Estate Group. This is my 20th year in the business. Definitely specialize in residential listings in North Jersey. Wayne is our hotspot, but not only limited to Wayne. We also handle a lot of buyers and just happy to be here.
Awesome. Thank you. So as we do with most of our seminars, we're going to start out with maybe a little State of the Union. As television shows get interrupted by our politicians, we're going to start our process off about a State of the Union in everybody's area of expertise. So Nico, I'll start back with you. Why don't you tell us a little bit about how the year has started in 2026 with lending?
Great. So the year has been, we're only 3 weeks in and it's been quite crazy with interest rates. The outlook on the year, everybody's pretty optimistic about rates trending down. Some good news recently, rates for first-time home buyers have crossed over 6% into the high fives. You have home buyers who aren't first-timers getting rates in the low sixes, which comparative to 12 to 24 months ago is almost a full percent lower. So things are looking better for financing when buying homes.
Awesome. Michael, why don't you tell us what's going on in the equity markets?
Sure. For the most part, last year, similar to this year, we're looking at the administration is obviously pro-growth, less cost to the government, lower rates, which is all accommodating the market. We think interest rates will probably go down maybe 1 or 2 times this year with the new Fed chair coming in. AI and things like that, and earnings have been very, robust last year and looking out to this year. But AI is one other thing that we're in the early innings of the ballgame for that, but it's clearly adding to productivity. The couple of concerns we have would be tariffs right now. The policy, because it changes all the time, causes uncertainty. There's some inflation.
Day to day,
yes.
It changes.
There's inflation as a result, and if they can manage the inflation, which stays 3.5%, that's manageable. If it goes up too high, that's a bad thing. And then the second thing is unemployment, which is actually very low right now. The strange thing is we don't see massive layoffs, but we don't see hiring going on right now. But when we put everything together, it really points up for the year, probably similar to what we thought about last year.
Okay. So, Mr. Jason, to put you on the spot here. So everyone's starting to prepare for tax season, right? As individuals, as small business owners, et cetera, et cetera. Anything that we should be aware of that has been tax law changes or tax changes that could affect our pocketbooks from 2025 coming into the new year? Tax laws or tax things that have had changes?
Most of the tax laws changes happened mid-year last year. So
Okay.
nothing as of right now, and as we all can understand and appreciate, Congress is slow acting on really any type of legislation at this point. So there's no changes for 26 specifically, but for 25 into 26, I guess, is some of those changes that occurred earlier in the year. One big one, I think, for real estate specific would be the SALT limitation increase, which could go upwards of $40,000. So it's a big number going from 10 to 40. So I think you're going to see a lot of potentially surprising, positive surprises for some individuals earning under certain thresholds, where they'll see some more money in the pockets as a
Okay.
result.
And SALT stands for what?
Sorry, state and local income taxes.
Okay.
Yeah, the
All right.
deduction that you're able to take for it.
Okay. Awesome. Why don't you give us an inventory snapshot?
Sure. So as of 2026, we are still very low in inventory, and that is causing the prices to obviously go up higher. Like today, in January, there were only 14 houses that have sold thus far. The average list price was about $775, but the sale price was $813,000, which is about 104%. Next door in Pompton Lakes, in January, they only sold 3 homes, and they've ranged between $446 and then $465 for a sale price. In Passaic County as a whole, 89 houses have sold thus far at $582 as a list, and then $593 as a sold price, which is about 102%. So lack of inventory is still causing multiple offers. We just experienced it with our last 3 listings this year, and the percentage over ask is still high. So it's still a great time for sellers. So if you're thinking of selling, this is where you should be right now.
And it's interesting because conceptually, when you think about what potentially could slow down the sale of real estate, you think of snow, right? And
Always has been an issue.
we have it coming on Sunday. Apparently, the world's coming to an end, and we've had snow, but yet real estate has still survived and thrived with buyers that are out there. And what we try to tell sellers is that buyers coming out in the snow is a good thing because they're qualified and they're ready to buy and they want to buy, right?
Yeah, last Sunday it was a snowstorm. I kind of took the video of us driving from our home to our listing, and the sellers were concerned, the buyers were concerned, but we had almost 20 parties there.
I
All right.
think that speaks to the low inventory. I mean,
Yeah.
once there is a house on the market, you're experiencing that,
Yeah.
influx of buyers, and that drives up the price. So, I mean, I think the trend from everybody that I speak to is positive. So I do think 2026 is going to be a more positive year. I think it's going to be a more stable year, if I could say that,
Yeah.
in the sense that we have some stability in the government as a whole. All the elections are kind of done, so people have kind of established themselves, and now we know what we're getting ourselves into. So I think that there's some solace that people take with that, and they might be ready to trade on that.
The interesting thing, though, is that the mass media, living in northern New Jersey is a different animal than living in the domestic United States and other territories, right? Because when Francesca goes through her statistics and we talk about selling at 105% of asking price and 11 offers and depleted inventory, that's not happening in most parts of the United States. So when you look specifically here, the things that we're articulating are specific to northern New Jersey. We're not talking about what real estate may look like selling in Florida or what it might look like selling in Connecticut. Those could be vastly different. So when we articulate about experiences here tonight, it's specific to the northern New Jersey market. So the goal here is to talk about selling, right? And to prep my house and capital gains and estates and trusts and how do I fund. So let's start all of that good stuff. And we're going to start with you, since it starts with you, right?
Oh my God.
You get a phone call. I want to sell my house. I'm thinking of selling my house at a high level, since we don't want to get granular, right? We got 30 minutes or less. Tell us, from your perspective, what are some of those things that you consult a seller about as someone has started the process of thinking, I want to sell my home. I'm going to sell in the next 3 to 6 months. what do I do to start to prep myself?
Yeah, that is our sweet spot. If you know you're gonna sell in June and you wanna get prepped before that, that's like our wheelhouse. Typically, I like to reference, we get you ready like your mother or your mother-in-law, whichever one is more picky, is coming to your house, right? So we get it ready. Kind of guide that seller through their house, look at it as a buyer. If something in the house you don't love, that buyer is not gonna probably love it either. So what we try to do is, tackle the curb appeal, make sure, number one, it's clean, make sure you declutter. Every room has a purpose, because a lot of times we deal with sellers that have lived in their home 20 years, 30 years, and you accumulate a lot of things, and then this one might leave and move out, and this one might move out too, and now you have this big house and you stop using rooms for a specific purpose. They're drop rooms all throughout the house. And now it's our turn to, once again, gather up those rooms, repurpose them, right? We just did a house, I'm not gonna say the address, but one of the room was, I think actually probably the last 6 houses, one of the rooms was a storage room. So it's like taking back that purpose. There's plenty of rooms to store it. Let's get all that stuff there and redesign, repurpose that room, because every room in that house, that square footage is a dollar amount attached to it. So let's reclaim it,
Awesome.
let's give it a purpose, and let's sell you above ask.
Okay. So Matt, talk to us legally, if I'm gonna start getting ready to sell my home, what are the documents that I need to start to prepare to look for and have ready for us?
Yeah, so I always try to tell my sellers that, selling a house are more reactionary. So you want to be able to present to a prospective buyer, first and foremost, if you have a copy of your survey or most recent survey, that's very helpful, because a survey is a land diagram which denotes what the property conditions are. So it's a good thing to share with a prospective purchaser so they see what they're getting themselves into. Another really prudent document is a copy of your owner's title insurance. So title insurance is a policy of insurance that you get when you purchase a property. It's usually accompanied with the deed, so it's given to a purchaser when they purchase a property and given with their deed. But having a copy of your owner's title insurance and the survey is an important documents to collate.
Okay. And if we're missing any of those, is it a
Not mission
hiccup or
critical.
what?
Not
Okay.
mission critical. We can always try to piece through that information, but it does help start the process, because again, and I'm sure we're going to get into this, when you get under contract, it helps navigate through the attorney review process a little bit easier, because buyer's counsel can see, any restrictions, any type of concerns of the property that they want to address in real time during attorney review at that juncture.
Yeah, okay, makes sense. So I'm really excited that Jason's here, because it can kind of add to what Michael has offered to us before in the past, and and reactive, and have conversation off of it. And a lot of the sellers that we work with and that are in this area are sitting on equity, right? And significant amount of equity. As Francesca talked about, a solid profile of people that we work with have been in their homes for 20 years, 25 years. They're empty nesters now. They're ready to get out of the area. And, when you sell your home and you have a significant amount of equity, sometimes there's questions around, what do I do with it? How do I, if I get a check for $500,000, where am I supposed to put it? How does that hurt me from a tax perspective? So, as a guest of honor tonight, I'm going to start with you.
Sure.
Why don't you talk to us a little bit about what capital gains are, what they mean, and let's start the dialogue there.
Sure. So capital gains is a preferential tax rate, not ordinary income. So it's a lower tax rate typically than your normal working income that you would pay every year. It's on assets that are held for a long term, which is considered a year or more, right? So for most people, it's their home, and it's the gain. You pay the tax on the gain of the from the sale of the home. The gain is calculated by the sales price less your cost basis. The cost basis is the amount of money that you purchased the home for, plus any improvements that you put into the home over the entire lifespan of owning the home. So for younger homeowners, it's a little bit easier to know that and calculate. For older homeowners, it becomes much more difficult. There's some more complexities to that, what cost basis could be. For example, if someone has passed away, a spouse has passed away, your cost basis could be stepped up to the date of death value. So there's changes to it, but for the most part, it's what you paid for the home and improvements that you put in.
Okay, and are there exclusions? So if we use husband and wife and husband team, we own a house, right? Do I get an exclusion to start with, and what are those exclusions?
You do, very good.
Yeah, I do this for a living.
You do. There is a Section 121 gain exclusion if you live in the house as your primary residence for 2 of the last 5 years, and you haven't rented the property out at any time during that span. You would receive, if you're married, a $500,000 gain exclusion, or if you're single, a $250,000 gain exclusion. If you're widowed, you could still potentially get that gain exclusion, but you'd have to sell the home within 2 of the last 5 years from the time when your spouse passed away.
Okay.
If it's past that, then it goes down to the $250,000.
Okay. So there are some variables associated.
There's variables in every tax law. There's
Right.
exceptions to every tax law, so it's hard to speak in absolutes. But for the most part,
So the overall theory of that is consult your tax accountant or your financial advisor to make sure you understand, right? So from a layman's
I was going to
yeah,
say
please,
also,
yeah.
I think some people are very good at keeping track of all the work they've done along the way, and it doesn't matter if they're young or old. And then there's those that don't keep track of it at all.
correct.
It's
And it
those,
hurts you.
yes, and it's those people that you really have to, before they sell, obviously, just get a whole list of everything they can think of along the way that they did.
Oh, yeah.
And then maybe they can dig through some records and find some backup to that and things like that. But it's critical for those people to figure that part of it
And
out.
give us, since you're on that topic, give us some examples of improvements or things that you may have done in the home that could count towards those exclusions.
So the obvious ones are always additions. You improved your kitchen. You did a bathroom. But it could be new roof. It could be a driveway. So it's a multitude of different things that add up over time. And sometimes you could have put 2 roofs on your house.
Right.
In the time.
And if you don't have the receipts, does that put you in a bad spot, or is
I mean, technically, under an audit, you could run into a problem. To be quite frank, I haven't
we are on
seen,
film?
I
So
know.
make sure.
I haven't seen, as long as you can provide reasonable numbers, and the one thing I would say is you should start when you first buy it and keep track of it. You need a ledger. You need to have those receipts. That's going to provide you with the ultimate protection. That doesn't mean that under an audit you would lose if you don't have the receipts, but you can't guarantee that you're going to be able to. So you need to keep track.
So we're in the scenario of that I'm 3 to 6 months out to sell my house, and as I want to start to prep, right? If I've been in my home 25 years and we haven't gotten to the point yet where I may buy my next destination.
Right.
We're talking solely from the perspective of I paid $400,000 for my house. It's now worth $1.1 million on the open market. I've got $700,000 in equity. You're telling me I can get a $500,000 exclusion as a married couple, but that still puts me in a position where I've got $400,000 or $300,000 or whatever it may be in potential $200,000 in potential capital gains, right? So now we've got to chop away at that.
As long as you have those,
As long as you can
have those
justify,
improvements and
right?
those cost
And that's
basis, yes.
roof, bathrooms, driveway,
kitchen,
hot water heater, kitchen.
bathrooms all throughout the house. I mean, there's a
Floors.
lot that flooring. A pool. You have a lot. There's a lot there, and the reason to keep track of it all is because oftentimes people think, am I gonna say too much? So they pull back. And the truth of the matter is the people that keep track of the records have the largest. You put way more in 30 years, let's say. You put way more into the home than you can ever remember.
Yeah.
Oh,
You forget.
absolutely.
Sure.
I mean, there's been plenty of times where clients don't have the list, and we go through it, and we say, so you never replaced your kitchen, you never replaced these bathrooms, you never replaced. Oh, I did. Oh, I remember this.
You know, paint the hallway.
Yeah,
Right.
well, I'm saying.
Yeah.
So you keep track of it. It's important to keep track of these.
So let's talk real quickly, and I'm going to start over here again, and it's going to come back to you real quickly. So let's say that at the end of all of that exercise, we do find out that there's 200,000 in potential capital gains. Just explain at a high level. I don't expect you to get into substance, but how does that become taxed? Is it immediately counted as, you know, an income, or just talk about how that would work?
So it is. It's an income on your tax return. When you file your tax return, you would need to account for that capital gain and pay depending on your tax rate, potentially a 20% tax on that for the federal side. The one thing I will say is what people always forget and discount is New Jersey. We live in a high tax state. There is no capital gains rate. There's no preferential rate for New Jersey. So depending on your income levels, that tax could be upwards of 10.75%, 11%, I would say, but 10.75%.
Yeah, and I love this conversation. I mean, we just talked about this. You could have a podcast just on capital gains and prepping yourself to get ready to sell. So, but I do want to get others involved. But tell us, I get a $200,000 check. I have my next destination. What are some of the ways that people can consider investing that? If I'm a 56-year-old individual, I've got my next destination, but I'm I'm preparing.
I mean, there's a few different sellers that are now looking to buy. There's the ones that are buying up, and obviously they've sold their home short term. They're going to need the money in a month, 5 months, so they should be in CDs and money markets and other high yield savings, treasury bills and things that you can't lose money in, but they're short term. There's the person that might be buying down. They've sold their house and they're just buying a smaller home or less expensive home. That person may have some additional proceeds. So they have some money that they're going to need for their down payment. They need to be short term on. Maybe there's some that now is medium or longer term savings. And then there's the others that sell their home and just decide we're going to rent. And they rent for two reasons. One, they're going down to Florida and they're not sure where they want to buy. So for like a year, they're going to rent. And again, we're short term with the monies or proceeds. Or there's the person that says, hey, we're moving into the city. And we're just going to rent there. And now we have some long-term assets that are available.
Okay. Jay, how does any of this change if someone has their home in a trust, not in a trust? Does that affect anything from a tax basis?
It could.
If I'm selling my home,
that's
right?
a complicated question because it depends on the trust. But if it's a revocable trust, no, it
So
doesn't.
talk. You know what? Maybe we should start at the start. What's a revocable trust versus an irrevocable trust at a high level definition?
So it's in the name. So it's revocable in the fact that asset is not truly gifted to someone else. It can be pulled back. So it's pulled back into your estate for lack of a better term. It's not a true gift. So as far as the IRS is concerned, a revocable trust is a non-existent. It's a legal document. It's a legal purpose. An extension of a will, I guess, a more purposeful will, if you will. So it doesn't, from a tax standpoint, it doesn't really change anything. It helps in Florida to avoid probate, right? There's tax reasons to do it, but not income tax reasons. An irrevocable trust, it depends if it's a grantor trust or a non-grantor trust. Those would have different implications. A grantor trust would potentially be seen as, again, an extension of the individual, right? Depending on how it's set up. So that would have very little, if no, impact at all on the tax side of it. An irrevocable, a non-grantor trust, though, would be something where it would have a significant impact. And the reason why is because you would potentially lose the gain exclusion.
Okay.
And you would also have a more compressed tax rate. So depending, as I said before, your capital gains rate goes up to 20%, but it doesn't have to be 20%. You could be less than that. In a irrevocable non-grantor trust, you would actually get to that 20% way faster. So you actually hit, so if you're a low income worker, but then you sell a large asset for a gain, right? You would actually have significantly lower taxes than 20% on the whole thing. Whereas if it's in a trust, it would just be taxed at 20%. Okay. So there needs to be planning and thoughtfulness to.
Okay.
And it's also in the titling of the asset is going to dictate the trust. Because remember, a trust is a separate entity within which it has to be funded. So the deed would actually recite the form of ownership and the type of trust, and then you would get into with the tax professionals, how we're handling the sale and the assets accordingly. By virtue of the trust agreement, that's going to govern, what we can do with that. But it's all in the titling.
Are there other things that you could put in the trust other than just the property?
Certainly,
Such as
bank accounts, stock accounts. You could put anything in a trust because the trust is a separate entity from an individual, and it can transcend, and it's governed by the trust agreement. So it's an estate planning tool which is utilized mostly for tax purposes to kind of eliminate assets from a person's estate to minimize their estate tax burden. Now state of New Jersey doesn't have estate tax, so it's usually used for different kinds of planning. But it's it's a vehicle not just for real estate, but for any asset a person owns.
So could you put if you owned your automobiles outright, you could put the
You gotta be careful with personal use assets.
Yeah,
It all depends.
There's
how it's-
requirements and how it's, so I mean, you could do something, but then becomes a problem of mechanics of using it and how it gets handled. So you wouldn't put something like that in there because that's gonna be something where you can run the risk of a personal use, exemption and, that's something you wouldn't want to do.
So, Nico, question came up in the chat, which we're going to engage with you on, is someone had referenced that I've got a lot of money in my house and I don't have my next destination, but I don't have a lot of money available to me. So I've got that $700,000. How do I get access to it, right? Because from Francesca's perspective, the hardest thing to do is position a home sale contingency when you're going to purchase a house. So what are some of the programs that are out there, in today's day and age that people might not be familiar with in order to overcome that?
Sure. So when it comes to financing your purchase after your sale, prior to your sale, the new thing today is everybody wants to be able to purchase a home before they sell their home up here. So if somebody's buying a downsizer, wants to be able to purchase their smaller home, move out of their old home, and then sell it. So how do we do that when all of our money's locked up in the house without selling? There is the world of second mortgages that exists, and what's becoming very common today is access to bridge loans, where individuals are able to access up to 80% combined mortgage debt. So someone who owns a home free and clear, it's worth $1 million, they can hypothetically take out a bridge loan for $800,000. The theory in using that is it's a short-term borrow. You take out the equity line of credit to access down payment monies, purchase your new property, and then the game plan with our real estate professionals will be, hey, let's get our client's current home sold as quickly after closing on the new home as possible to effectively pay off the debt that you just established.
Okay. And is there a name to that, or is it?
So those are bridge loans. Now, if an individual wanted to accomplish the goal of buying now and selling a home later, we have the buy now, sell later program, which encompasses a bridge loan and another tool that allows you to achieve that goal.
Okay. Mike, are there other ways to fund a purchase if, other than buy before you sell, talk about maybe some other ways?
Sure, yeah, I'd say that the two most common ways, one would be a 401k loan. An individual that works at a company has a 401k plan. They can access a loan up to 50% up to $50,000. So if they have $100,000 or more in their account, they can access a $50,000 loan that typically you pay back over a 5-year period. And then a husband and wife, if they each have that, you have $100,000 that you have access to. The nice thing on it is the interest you're paying, you're not paying back to a bank or financial services company, you're paying that back to yourself.
Yeah, and I think there's actually been, I don't know if it's misnomers or what I've been reading is, I think that the current, current administration is trying to allow you to access your 401k to use to purchase your first home.
Yeah. And even during COVID, they had wider ranges of loans that you could take at that time.
Right.
So it wouldn't surprise me if at some point they changed the rules on this a little bit.
Okay.
Because the $50,000 limit has been in place for 25, 30 years. It's been a long time.
Okay.
The other option would be you might have an investment account, a brokerage account, that you own, different stocks and bonds and mutual funds, and you're hesitant or don't want to sell those things because either you have Apple in there, you don't want to sell it, or there's large capital gains if you sell something. We can collateralize a loan against an account, and usually you can access up to about 60% of the value. So if someone has $300,000, in their account, about $180,000 they have access to. And it takes no less, it's maybe a week at the most to get it in effect.
Okay. So let's come back to Francesca now. Talk to us a little bit about the sale process itself. I've agreed to work with a professional. My house is going to go up on the market. What are some of the expectations and things that we should be aware of that will be happening during the sale process?
So I always inform our sellers that first week is going to be very chaotic. So you've taken your time, you've prepped a home as much as you want to. We always say, are you open to this, that, and the other thing? And some agree, some choose not to. Then the sign goes up. I literally will hit submit, and at times the phone rings. Our third-party app will start making appointments at that time. Right now, that first week should truly be your last week on the market. However, you're going to be asked not to be there, right, for these showings, and you will be very stressed. So what I've consistently, and you can agree with me, what I've consistently said to the sellers is this is going to be a little bit of a shaky week. Just understand and level set with yourself that it's going to be hectic. You're going to be leaving the house. You're going to feel very stressed. That thank goodness it's now rather than 10 years ago, because the opposite took in play, right? Now there's not enough properties. 10 years ago, there were so many properties that it would take you 6 to 8 months to sell your house. So though that week is crazy, week 2, you should take a breath.
Okay. So, Matt, we accepted an offer, right? Francesca's done her job and gotten to the point where we've gotten hyperactivity, you've gotten significant interest, you've agreed to terms conceptually on a contract. Walk us through the phases of what's after that from a legal perspective.
Sure. Once a seller signs or countersigns a contract that's presented, so again, a real estate agent for a buyer will present the seller with the contract. The seller says, yes, this is a good price, this is good terms. They countersign the contract, we enter into attorney review. Generally, attorney review is started by the buyer's attorney. They will provide an attorney review letter. We would respond to that attorney review letter with the seller's response. Assuming the attorney review period is good and we conclude attorney review, now we're under contract. And again, we're reactionary. So at that juncture, the buyer would proceed with their inspection. We would await the results of the buyer's inspection. We would negotiate on any inspection concerns. Assuming that is in good order, then we would await the buyer's mortgage commitment, which might be in tandem with the inspections. Assuming that is in good order, then we would get the buyer's title work, prepare the sale documents. In a seller's situation, we pre-sign the sale documents ahead of time. So sellers don't attend closings, only buyers do, and buyers' mortgage professionals. So we would sign all of the sale documents in advance and then just await for the closing. And at the closing, the documents would be signed by the buyer's mortgage would fund, and then the seller's proceeds would be wired. So it's kind of a seamless process, but it is a fast process and it moves relatively quickly.
So how long? Timelines for a real estate transaction are about how long?
I would say 35 to 40 days.
Okay. Moves quick.
Yeah, it does move quick, which I always tell my sellers, we have to act quickly because, again, buyers are anxious. Buyers are anxious to get in the property. And, at the end of the day, it inures to the benefit of the seller because then they get their funds.
I mean, and obviously we're talking at a real high level, at 30,000
Sure.
feet as to how the
100%.
transaction works. There's, a number of nuances associated with, everything that you talked about and everything that you
Yeah.
talked about
Yeah.
as well, right?
Yes, a lot.
Not every property goes that fast, not every
Yeah.
process is that quick. There are some with post UNO occupancies
Right.
attached to it.
We
So
can-
they are a little bit more complicated and a
Throwing in
little
your
bit,
acronyms like SALT.
yeah.
What's a UNO?
Post-closing use and occupancy. So essentially you sell your home, you're no longer the seller, you're a post.
Occupant. You're an occupant
Occupant.
of the space.
Thank
for a
you.
period of time.
I
Not
love
a
it.
tenant.
I've been an
Ten
occupant of
times
space for
in.
15 years.
Not a tenant, not officially a tenant, but you feel kind of like one of them. You're still carrying tenant insurance.
You are carrying occupant insurance.
Let's start the conversation. We're killing everybody in
Yeah,
the
yeah.
internet world here. All right, so we said that we would keep everything to 30 minutes. I think we're a couple minutes over, but as I like to do with every seminar, is I want to give our colleagues here a chance to maybe say 10, 15 seconds about something that resonates with them or a takeaway message. So Nico, please, let's start.
So as a lender, we work with so many buyers and we see transactions. So my tip to sellers would be to be prepared. Speak with your attorney, get everything in order so that when the buyers are ready to close, you are not the ones who are causing any sort of delays. You can close and everything is seamless for yourself.
Excellent. Michael?
I kind of echo what Nico said. I mean, it's really just a matter of being prepared at this point. It's the market is so competitive that you really just have to have everything lined up and ready to go.
Awesome. Matthew?
Trusted advisors. Create a good team of trusted advisors. And I think that being prepared, they will help you be prepared, and we will help you get to that finish line.
Jason?
What can I possibly say? Be prepared. That's it. Be prepared.
Yeah. Francesca?
I'm gonna switch it to you. What would
Okay.
you like to say?
I
What's your
mean,
aha moment
my
today?
takeaway always is whether you're going to use any professional in this room or not, just align yourself with someone that you trust. And I always like to use the analogy, if I had a heart problem, I wouldn't go on Google and just try to chat GPT my heart problem. I would engage with a heart professional and someone that has experience and knowledge on how to handle and take me down a proper path. And it's no different than tax, law, mortgage lending, financial services, and realtors. If you're going to sell your house, don't take pictures on your cell phone and throw it up on Zillow and put it up for $150,000 more than what you think it might be worth, because you're doing yourself more harm in the long run than not. So I would really implore you is to find people that you trust in their profession and engage with them to help support you down your journey.
100%. And get to know your person, right? Either here or elsewhere, they might have a great reputation, but maybe you don't get along. So just interview someone and get to know them and take a recommendation. And Google reviews aren't so bad. Just make sure, that they're consistent. Look from the bottom up.
So we thank you for your time. I will end by saying, if you would like any of our colleagues' information to get in touch with them personally, please leave a note in the chat or reach out to Francesca and I. We're happy to put you in contact with any of them. But thank you, and be on the lookout for our next quarterly event, which will happen sometime in April. Thank you very much.